Imagine a single company worth more than every country on Earth, except the United States and China. As a clear sign of a very healthy and totally normal market, that company exists. It makes computer chips. And in 2025, AI firms are driving 80% of all US stock market gains, while industry titans openly warn that the whole thing might be built on sand. You're about to see how $40 billion in corporate AI spending produced almost zero returns, how a Chinese startup erased $600 billion from the market in one afternoon, and how the people making billions from this boom are the same ones warning about its collapse. If you love watching financial disasters unfold in real time, hit that like button and subscribe to Money Legends. The frenzy started quietly enough. When NVIDIA, the chip maker behind most AI systems, hit a $1 trillion valuation in May 2023, analysts called it impressive, but sustainable. The company had carved out a dominant position in graphics processing, with steady revenue from gaming and data centers. Nothing about the number seemed alarming. Then, within 24 months, that $1 trillion became $5 trillion. NVIDIA quintupled faster than any major company in history. For context, that valuation now exceeds the combined worth of Walmart, ExxonMobil, and Johnson & Johnson. One chip company worth more than 3 American industrial giants put together. Wall Street analysts started pulling up old charts and finding uncomfortable parallels. The forward price-to-earnings ratio for AI stocks had blown past anything seen in decades, at least during previous tech manias. Investors believed companies would eventually figure out how to monetize their products. But in early 2025, they were betting on AI firms that still hadn't figured out how to turn all the hype into actual profit. The disconnect between enthusiasm and reality had become almost comical. Startups with zero revenue were securing 9-figure valuations. Established firms were slapping AI onto their investor presentations and watching their stock price double overnight. Each new funding round validated the previous one. Every soaring stock price justified the next investment. The game became momentum, not fundamentals. Oracle, a 50-year-old software company known for providing boring database subscriptions to boring enterprise customers, announced it was pivoting to AI. Within 8 hours, the company gained more market cap than McDonald's. Not from earnings, not from products, but from new customers. Just from saying those 2 magic letters. Tech giants committed tens of billions to AI infrastructure in single quarters. These bets were enormous and entirely dependent on AI actually delivering returns that justified the spend. Billions poured in daily, inflating valuations beyond any rational calculation. Each investment created pressure for the next one to be larger. Nobody seemed interested in asking the obvious question: where are the returns? An MIT research team decided to find out. What they discovered should have ended the party overnight. After analyzing corporate AI initiatives across the United States, the researchers published a report that landed like a bomb in finance circles. Companies had collectively sank between $35 and $40 billion into generative AI projects. So what's the return on that investment? For 95% of organizations, absolutely nothing. No profit improvement, no efficiency gains, no measurable impact whatsoever. $40 billion essentially lit on fire. But the report revealed something even more troubling than simple waste. The money was flowing in circles. Investment firms would throw billions into AI startups. Those startups would spend the cash buying cloud services and chips from tech giants. The tech giants would report surging revenue, which justified their soaring stock prices. Investors would see those stock prices and put more money into AI startups. Round and round the money went, creating the illusion of a thriving industry. Wall Street started calling it circular financing, though elaborate game of musical chairs might have been more accurate. Here's how it worked in practice. Salesforce signs a massive cloud deal with an AI startup. The startup pays Salesforce using venture capital money. Salesforce's quarterly revenue spikes, which validates its AI strategy and pushes its stock price higher. Investors see Salesforce's growth and decide AI is clearly working. So they pump more capital into AI startups. Those startups sign more deals with Salesforce. The wheel keeps spinning. The problem is, none of this money was coming from actual customers paying for AI products with their own operating profits. The entire system ran on investor capital recycling through the ecosystem. Growth looked spectacular on earnings calls, but it was growth built on other people's bets rather than genuine demand. By early 2025, cracks were forming. Major AI projects got quietly shelved after failing to deliver results. CFOs started demanding ROI projections that nobody could provide. The market kept climbing anyway, but anyone paying attention could see the foundation was hollow. Two companies, Nvidia and Microsoft in particular, had become load-bearing walls for this entire unstable structure. Every major AI system on Earth runs on Nvidia's chips. ChatGPT, image generators, autonomous vehicles, corporate chatbots, all of it is powered by Nvidia's graphics processing units. The company has transformed from a gaming hardware maker into the picks and shovels supplier for an entire technological revolution. That position has made Nvidia the most valuable company on the planet. Microsoft is playing a different but equally critical role. The company bet everything on becoming the infrastructure backbone of AI. Azure cloud services, partnerships with OpenAI, enterprise AI tools. Microsoft is building the plumbing that every AI application needs to function. The commitment is huge. $388 million spent every single day for 3 months straight on data centers and processing capacity. And these two giants feed each other. Microsoft buys Nvidia chips by the billions to power its AI services. Nvidia's revenue growth depends heavily on Microsoft's continued spending. Microsoft's AI offerings only work because Nvidia keeps delivering faster chips. Their fates have become completely intertwined, each company's stock price validating the other's trajectory. This interdependence creates a situation that should have terrified investors. If either company stumbles, both could fall. And if both do fall, they'll take a huge chunk of the market with them. These aren't small players you can ignore. Together with just 3 other tech firms, they now represent nearly a third of the entire S&P 500's value. Financial advisors have started having quiet conversations with clients. What happens if someone builds chips that challenge Nvidia's dominance? What if Microsoft's AI investments never generate the promised returns? The questions are uncomfortable because the answers are catastrophic. The entire AI rally has become a bet on two companies continuing to execute flawlessly forever. Their quarterly earnings calls move markets more than economic data from entire countries. Then on January 27, 2025, a Chinese startup most Americans have never heard of proved just how fragile that bet really was. The morning of January 27th started like any other on Wall Street. But by lunch, Nvidia had lost more value than most countries produce in a year. DeepSeek, a Chinese AI startup, had just announced something that should have had been impossible. They'd built an AI model rivaling the best American systems for approximately $6 million in computing costs. Microsoft had spent $35 billion in a single quarter chasing similar capabilities. The math detonated the entire investment thesis underneath the AI boom. Nvidia's stock cratered 17% in a single session. Nearly $600 billion in market value vanished in 6 hours, the largest single-day loss for any company in stock market history. The broader tech index shed $1 trillion as investors rushed for the exits. Trading floors that had been celebrating record highs the week before now look like disaster zones. The DeepSeek announcement struck at something deeper than stock prices. It attacked the story that justified everything. Silicon Valley had spent years convincing investors that AI leadership required unlimited budgets, exclusive access to the most advanced chips, and data centers the size of small cities. That narrative had justified trillion-dollar valuations and attracted institutional money from around the globe. DeepSeek had just demonstrated that a startup operating under U.S. export restrictions without access to the best American semiconductors could match that performance for pocket change. If that was true, what exactly had all that spending purchased? Analysts who'd been cheerleading the rally suddenly found their models worthless. The questions they'd been ignoring for months became impossible to avoid. If cheaper alternatives could match expensive systems, what justified the premium prices? If innovation didn't actually require billions in infrastructure, were any of these valuations sustainable? The market recovered somewhat in the following days. Investors told themselves it was an overreaction, a temporary panic. But something had shifted permanently. The narrative of inevitable American AI dominance had cracked, and everyone had seen what was underneath. The people who'd built this market were about to start saying the quiet part out loud. There's a particular kind of alarm bell that rings when the people getting rich from a boom start warning it might be a bubble. In early 2025, those bells were deafening. Sam Altman, the CEO of OpenAI, said it plainly in a January interview. An AI bubble is ongoing. No hedging, no corporate spin. The man running the company most synonymous with AI hype had just admitted the valuations had detached from reality. Altman had every incentive to keep the party going. OpenAI had raised billions at sky-high valuations and needed continued investor enthusiasm to survive, but he warned them anyway. Jamie Dimon, the CEO of JP Morgan Chase, went further. The man managing $3.9 trillion in assets told investors directly that massive amounts of capital were being wasted on AI projects that would never generate returns. Stock market corrections were coming, he said, as reality caught up with expectations. Dimon had navigated the 2008 financial crisis better than almost any other bank CEO. When he spotted trouble, clever money paid attention. Ray Dalio, the Bridgewater Associates founder, whose fund successfully navigated the dot-com crash by recognizing warning signs others dismissed, compared the current AI mania directly to 2000. Same ingredients: excessive speculation, circular financing, investors ignoring fundamentals while chasing momentum. Dalio has been right before when everyone else was wrong. His assessment carries weight. These are the architects and beneficiaries of the boom itself, breaking ranks to sound the alarm. Behind closed doors, the warnings are more urgent. Money managers are quietly reducing their AI exposure while maintaining public optimism. Corporate finance teams are drafting contingency plans for rapid devaluations. The smart money is hedging bets that the dumb money is still doubling down on. Stock prices keep hitting new highs, while the smartest people in finance openly question whether any of it is real. Everyone knows the music will stop. Nobody wants to be first off the dance floor. But when it stops, there'll be nowhere to hide. Here's the part that should keep you up at night. Even if you've never bought a single tech stock, you're probably exposed to this bubble. 30% of the S&P 500's entire value now rests on just 5 companies. That level of concentration hasn't existed in half a century, not since the conglomerate boom of the early 1970s, which ended in widespread portfolio devastation that took years to recover from. The math is simple. If those 5 AI-linked giants stumble, the entire index collapses with them. Here's the thing. Millions of Americans who think they're diversified aren't. Anyone with a 401k invested in index funds has unknowingly bet nearly a third of their retirement savings on 5 tech companies continuing to defy gravity forever. And most of them have absolutely no idea. Pension funds responsible for teachers' retirements, university endowments funding scholarships, insurance companies backing life policies. They've all poured billions into what they believed were balanced, conservative portfolios. Instead, they built concentrated bets on AI hype wearing the disguise of diversification. When Nvidia's stock crashed during the DeepSeek panic, the damage didn't stay contained to tech investors. Financial advisors across the country fielded panicked calls from retirees holding supposedly safe portfolios. The contagion ripped through mutual funds, ETFs, and retirement accounts before anyone could react. Risk departments at major banks have started running stress tests. What happens if AI valuations correct by 40%, by 60%? The results are catastrophic in every scenario. Margin calls would cascade into forced liquidations. Credit markets could freeze as institutions scramble to cover losses. Unfortunately, financial history offers zero comfort here. The railway mania of the 1840s, the crash of 1929, the dot-com implosion, the 2008 housing crisis. Every bubble of this magnitude ended in devastation that spread far beyond its original sector. The AI bubble has grown so large that its collapse wouldn't just hurt tech investors. It would cascade through the entire global economy and everyone trapped inside it. Real innovation does exist. The technology will transform industries, but transformative potential and sustainable profit are separated by decades, not quarters. Investors confusing excitement with returns are about to learn that lesson the hard way. The smartest money isn't abandoning AI. It's demanding proof. Actual revenue from actual customers creating actual profits. Revolutionary technology means nothing if that business model runs on nothing but hype and hope. History teaches one truth. Bubbles don't deflate slowly. They pop. What survives won't be the loudest promises. It'll be the boring discipline of margins and retention. So what's your take? Innovation unfolding or financial disaster in slow motion? Drop your thoughts in the comments below. If you love stories where billions vanish faster than they appear, hit that like button and subscribe to the Money Legends YouTube channel. Click here and watch the next one. Trust me, it's epic.